Hi guys, thank you for coming online. Uh, can you all hear me? Okay, right. Well, last week we did an introduction into corporate finance and treasury. All right. Do you all have any questions from last week? Okay, so if there are no questions, we can continue. By the way, I wanted you all to watch some movies last week. Can you all remember? We discussed about some rogue traders. Nick Leeson from Barings Bank, Kwek Adeboli at UBS. Then we had Jerome Kerwell, Society Generale, and Bruno Excel at JP Morgan. Right, so I wanted you all to watch The Rogue Trader, the movie. Along with that, I would have recommended a few more movies, The Big Short and The Wizard of Lies. Right, so I hope you've been watching because there's so much that you could learn from these movies. Right? Even the terminology is something that you can learn. Okay, because it helps if you hear these words in advance. Things like derivatives, swaps, futures, and it also gives you an idea about how these things happen, how trading happens. Something which you do not normally see in your day-to-day banking activities. Most of you might not see it. Right? So these are very highly technical stuff which happens within banks, which most unfortunately are not exposed to. Right? It gives you a perspective of well, actually, the things that you can do within a bank. Right? It's not just a branch or credit and all that. It's also certain units which deals with markets, right? So I hope you watch these movies. Still have time? Do watch them. Okay, so let's move on to today's area. Right, so let's cover equity today. Not in great detail. This what we learned today. Will help you prepare for some of the questions that might be asked at the exam. Right, so this is a very exam-focused course. We are not going into great detail, just the outline of most of the areas, which is more than enough for you all to tackle the exam, right? But I would also advise you to read further, gain further knowledge, so that you understand markets and the dynamics of banking. It gives you makes you a very rounded banker. That is, if you want to progress within the bank, so it's up to you, right? Okay, give me 1 second. Okay. Well, if you want to raise funds in the market, if you want to do a fundraising exercise in the market, there are two things you can do, right? Either you can go to money markets or you can go to capital markets, right? So fundraising. Can you all see the board, by the way?
Yes.
Okay. Can be done through either money markets or in capital markets. Do you all know the difference between these two? What is the difference between money markets and capital markets? Money markets deal with instruments which are less than 1 year. So they are short term. Whereas capital markets usually deal with long term instruments which are more than 1 year. So in money markets, you have short-term instruments, things like call money, repos, which have maturities less than 1 year. And on the other hand, capital markets, you have debt as well as equity. These are the tools under capital markets. You have debt instruments, then you have equity instruments, right? So debt can be instruments such as treasury bills or treasury bonds. Then you have corporate debt. So these are government securities, G6. Then you have corporate debt, such as commercial papers and debentures. And then you have equity. Okay. So if you have any questions, you can ask. Okay, so my next question, what is the difference between debt and equity? What is debt? What do you mean by debt and what do you mean by equity? Are they the same or is there a difference between the two? What do you think? And this is something you would have learned in grade 2. The differences between debt and equity. And so equity gives you ownership. If you invest in equity or shares, that means you own the company, right? You own the you own part of the company. Whereas if you invest in debt, there is no ownership. It's like giving an advance or loan. Very good point. What else? What are the other differences? Yes, another good point. Debt has a maturity, whereas equity, there is no clear maturity. Equity will mature under two circumstances. Either the company has to buy back their shares or the company has to be liquidated. Otherwise, there is no maturity. Very good point. What else? Come on, this is grade 2. Grade 2, what you learned, we are doing a revision. Give me more points. Yeah. So in the case of a liquidation, right, creditors will get priority. Whereas if you own equity, you have least priority in a liquidation. Very good point. What else? Debt we have, yes. Creditors will get interest. What you pay on debt is called interest. What do equity owners get? What's that called?
Dividends.
Very good. They will be paid dividends. Sorry, there was another point. Creditors have no voting rights, and if you have equity, you are entitled for voting rights. Very good. What else? Then what about the payment of interest and dividends? Yes. Okay. Right. Marisha also makes a valid point. We'll come back to that. What about the payment of interest and dividends? Can you decide not to pay interest? Can a company decide not to pay interest? One particular year, in a given year, can a company decide that they will not pay interest on their borrowings? Can they do that? They can't. Right? So interest payment is compulsory. But can a company decide that they will not pay dividends in a particular year? Can a company decide not to pay dividends in a particular year? Interest, there is no choice. What about dividends? Dividends, dividend payment is not compulsory. Yeah. So in terms of return, which one gives the highest return? Debt gives a higher return or equity gives a higher return? Equity. Yeah, I also tend to agree that equity should give a higher return because, as Manisha you said, see, in case of a liquidation, equity owners get the least priority. Yeah? So they are taking a higher risk than creditors, right? Than the lenders. So to compensate for the risk, they should earn a higher return. So equity technically is costlier than debt. Okay. So this is what you have studied when you were in grade 2. Nothing new. But what is the real difference between debt and equity? The real one. Actual difference between debt and equity. I'll give you a clue. I'm referring to the risk of performance. Who takes the risk of performance in debt and who takes the risk of performance in equity? What do you think? it's let's say this. Let's say you need to put up a building, right? The company needs to put up a building, and let's just assume it costs 1 billion. 1 billion bucks to put up a building. Okay, now they can either decide to raise it through debt. The 1 billion can be raised either through debt or through equity. Okay. Now, if it had been raised using debt, right? Let's say this is done in 2019. So come 2020, the building is completed, but due to COVID-19, you can't find any tenants, no tenants for the building. And it has cost you a thundering amount of 1 billion bucks. And let's say it's 100% debt funded. No tenants, so no revenues. Now, if you don't have revenues, can you tell your lenders that you can't pay interest? Can you tell your lenders that you can't pay interest? No, you can't. So one way or the other, you have to make sure that you pay the interest. That means the risk of performance in the case of debt is borne by the borrower. Then what happens in the case of equity? If this 1 billion had been raised through equity, if you can't find tenants, do you still have to pay your dividends? If you can't find tenants, do you have to pay dividends? You need not. Right? So the risk of performance in the case of equity is taken by investors. Is that clear? So depending on the type of instrument, the risk of performance can either be with the borrower or with the investor. Now this is why Sri Lanka is actively looking for foreign direct investments, FDIs. FDIs. Yeah. So that is because if our project and our development work can be funded through foreign direct investments, until there is some stability with those investments, until they start making money, right, the country does not have to take the risk of its performance. But what we have right now is mostly external debt. Most of our projects are funded through external debt. So the risk of performance is with the country. Yeah, so that is why they are trying to shift it, the risk aspect shifted to the investor by finding FDIs. So that's why it's critical for the country also. Understood? Any questions? Okay, so if there are no questions, let's continue. Method of financing. Right? Methods of financing. How do you finance projects, right, or investments? Can either be indirect finance or direct finance. Indirect finance is where an institution stands between the lender and the borrower. Right? Obviously, like in the case of a bank, there is always an intermediary. Okay, so it's like taking a housing loan or a personal loan. That's indirect finance. That is because the borrower and the lender are not dealing with each other. Now, when you go to a bank and you take a loan, you don't know who has given the money to the bank. That's because there are so many depositors. Right? And when you go and deposit money in a bank, you don't know who's borrowing. Right? It's at the bank's discretion. So there is not just one borrower, but there are many borrowers, quite fragmented. Whereas direct finance is where borrowers sell securities directly to the lenders in financial markets. Right? That is where the borrower and the lender interact with each other. There is no intermediary. So it's in a way, it's like direct finance is like a love marriage where there is no intermediary, and indirect finance is like a proposal. Marriage through a proposal where a broker or an intermediary gets involved. Direct finance provides financing for governments and corporations. Now, institutions like the IMF, IFC, the ADB, all of them lend to governments, to various governments. And they interact directly with the government. They don't come and intervene or invest through an intermediary. Right? They eliminate the intermediary. Through their contacts and their touch points, they directly deal with governments. And if they want, they will invest in corporates as well. Because we have seen the IFC actively investing in several companies in the country, right, through equity. The fund flow through the financial system. So if there is direct finance, the funds will be transferred through an intermediary. Okay, the lender will give money to the borrower through an intermediary. Whereas if there is indirect finance, so if there is indirect finance, it will go through an intermediary. Direct finance does not, it cuts down on the intermediary. There is no intermediary in direct finance, quite obvious, right? So the funds flow directly from the borrower, the lender to the borrower in the case of direct, whereas indirect it flows through an intermediary. Financial markets are places where financial instruments are bought and sold, right? Can be money market instruments or capital market instruments. These markets enable both firms and individuals to find financing for their activities. These markets promote economic efficiency. They ensure resources are available to those who put them to their best use. And they keep transaction costs low. Very important aspect. Right? Because now, if the transaction cost is high, then the purpose is defeated. Right? Why you need markets is to make the process efficient and eliminate or minimize transaction cost. Otherwise, on your own, you will have to go and find lenders or borrowers. Not easy. Yeah. So if you are borrowing money, it might be difficult for you to find a willing lender, right? Because some lenders, although they have money, they may not have the expertise. Okay. All right. So, efficient markets. What do you mean by an efficient market? What are the signs or the features of an efficient market? Or a perfect market? Remember, this is grade 2. Perfect markets, imperfect markets. What are the features? What are the features of a perfect market? Market is perfect. We have heard of perfect markets and imperfect markets. What are the features of a perfect market? Very good. There are many or an infinite number of buyers and sellers. Good point. What else? Homogeneous products. What about information? Information is there is information symmetry. Information is not asymmetric, it's symmetric. That means everyone has the same information. Yeah, good point. There are no barriers to enter or exit. Good point. What else? What about transaction cost? No transaction cost. Very good. Price controls. Yeah. Mobility of resources. So you can use resources to produce anything you want. Then taxes, no taxes. Yeah, can maximize profits in the short run. Then infinite borrowing or lending can be done at the risk-free rate. You can borrow and lend unlimited amounts at the risk-free rate. Okay, so these are features of a perfect market. But unfortunately, markets are not perfect. So most of these points are not valid. But these are the features of perfect markets. Now, since perfection is not possible, it's very important that markets at least move towards these things. Right? Move towards this and become more and more efficient. Yeah. So it encourages transactions if a market is efficient. The role of financial markets. So this bridges the gap between borrowers and investors. Now, borrowers can be corporates or the government, even individuals. And investors can buy shares, bonds, or give deposits to the bank. And in turn, the bank will lend the money out to corporates or the government. Right? So money markets and capital markets, like what we discussed earlier. Money market refers to the market for securities with maturities of 1 year or less. Capital markets refer to markets for longer term debt securities and equity securities that have no specific maturity date. Okay, so any questions up to now? financial markets can either be primary or secondary, right? Primary markets and secondary markets. So primary market is, well, if I draw an example, it's like getting married for the first time. And then you are trading in the primary market. But if you get married for the third time, the second time and beyond, third, fourth, or fifth time, then you are trading in a secondary market, right? So primary market means getting married for the first time, and secondary market means getting married beyond the first time, right? So first time, remember, is always easy, which is why you need to complete your exams also the first time. Don't postpone to the next time, right? Right. So primary market in the case of financial instrument is where an instrument is issued for the first time, right? A primary market is where an instrument will be issued for the first time, whereas the secondary market is where the instrument that has been issued in the primary market trades subsequently is called the secondary market, right? So there are two types of markets, primary market and secondary market. An instrument is issued for the first time in the primary market, and subsequent trading happens in the secondary market. Okay, so for example, if it's an IPO, like in this case, the company will issue shares at 10 rupees each. IPO. Now, recently, Sri Lanka also had several IPOs. We had Winforce, then there was Chris World, and recently there was Prime Lens, right? So the latest was Prime Lens. It went at, if I'm not mistaken, 10 rupees 40 cents. So the IPO price was at 10 rupees 40 cents. Then investors can buy directly from the IPO, right? And when an investor buys from the IPO, the money goes directly to the company. It doesn't go anywhere else. It goes directly to the company. But subsequently, if you trade in the market, then it trades in the secondary market, right? So none of the money that's traded in the secondary market goes directly to the company. It doesn't go like that. The money that is traded from in the secondary market goes to these investors, not to the company that raised the issue security. Yeah. Any questions? Primary versus secondary markets. A primary market is one in which a borrower obtains funds from the lender by selling newly issued securities. Okay, so remember, it's newly issued securities, right? So buying shares of JKH from an IPO. Then secondary financial markets are those where people can buy and sell existing securities. Okay. So securities which have already been issued, you trade in the secondary market. So if you had not purchased a share from the IPO, then you'll have to buy it from the secondary market. Now, financial assets versus real assets. So what are financial assets and what are real assets? And financial assets include securities, like stocks and bonds, anything which is financial, derivative contracts and currencies. Those can be financial assets. Whereas real assets are something which you can touch and feel, things like real estate, plant and machinery, property, vehicles, commodities. Right. Next one is, what is a share? A part of this we discussed earlier also. So what is a share? Yeah. Shares or securities represent ownership of a company. This one we discussed earlier also. Shares represent an ownership in a company. The share represents a claim on the company's assets and earnings. Okay, so a share represents a claim on a company's residual assets and earnings. Residual, that means once all the liabilities are left, right, by disposing of your assets, after settling all liabilities, what remains is the residual portion which belongs to shareholders. And as you acquire more shares, the ownership stake in the company becomes greater. When you keep buying shares, your stake in the company keeps increasing. Whether you say shares, securities, equities, or shares, it all means the same thing. Being a shareholder or an owner, if you have any questions, you can ask. So, since there are no questions, being a shareholder or an owner, if you're a shareholder or owner, a holding company share shares means that you are one of the many owners of a company. Holding a company's shares means that you are one of the many owners of a company. Right? So if you own 1%, let's say of John Keel's, it means you are having 1% and the balance 99% of the ownership is with someone else. Right? A share is represented by a share certificate. Now you don't have certificates anymore. Everything is in your CDS, your central depository system. So when you want to redeem your shares, you have to take this certificate and go to CDS. Today, these records are kept electronically. And so there is no more share certificates. No more share certificates. You will get a CDS statement, which gives you actually it's the what it gives is the same as a share certificate, right? Only thing it's scriptless. You only have to open a CDS account and transfer your shares into that. Being a shareholder of a public company does not mean you have a say in the day-to-day running of the business, right? So just because you buy 1% of John Keel's, it doesn't mean you can go every day to John Keel's and tell them what to do and what not to do. Okay, it's not done like that. So you can't get involved in dairy operations, no way. Instead, get one vote per share to elect the board of directors at annual general meetings. You can appoint the board, right? And the board of directors run the company operations on behalf of shareholders. So it is the board of directors who run the show. Yeah. So the board of directors have a fiduciary responsibility by other shareholders, right? They have fiduciary responsibility, and they should work in the best interest of the organization. So this is where corporate governance and all that comes into play. The importance of being a shareholder is that you are entitled to a portion of the company's profits and have a claim on the assets. So if the company is wound up, you get a portion of your investment back. That happens through sorry. The stake that you have in the company, it gives you the right to either earn a certain percentage of the profits, or if the company is liquidated, you can have a proportionate amount of the liquidation proceeds. Right. Profits are sometimes paid out in the form of dividends. Like what we discussed earlier, you invest in equity, the return you get is called dividends. Your claim on assets is only relevant if a company goes bankrupt. Right? You will never claim your assets unless the company goes bankrupt. If it goes bankrupt, then yes, you have to recover the asset. In case of liquidation, you will receive what's left after all the creditors have been paid. Remember, equity, as we discussed at the beginning, very beginning, has least priority when it comes to the liquidation process. But creditors have a higher percentage. Okay. So that point is very important. You will only be paid after all creditors have been settled. Right? If there is a residual amount, only you get paid. Remember our discussion earlier? By becoming an owner, you assume the risk of the company not being successful, right? Remember what we discussed earlier? The risk of performance, if it's funded through equity, is with the borrower. The investor. With the investor. Right? So risk of performance in the case of equity is with the investor. Another extremely important feature of shares is the limited liability. Right? So there is a veil of incorporation, what we call a veil of incorporation, which prevents public from suing individual shareholders unless they have committed something seriously wrong. If things are in line with the rules, as an owner of a share, you are not personally liable if the company is not able to pay its debt. And so if you have purchased shares, the maximum amount you will lose is the face value that you invest. And due to the veil of incorporation, you are not personally liable. Although you own equity and you are a owner of the company, you are not personal liable. Share capital. Continuation of the discussion. Share capital is the amount raised by issuing shares. How much are you going to raise through the exercise? Calculated as per share value into number of shares. When a company is formed, the legal documents state the authorized share capital of a company. So this equation, share capital. So it's the price of a share into the number of shares that have been issued. So if a share is priced at 10 rupees and it has 1 million shares in issue, so total share capital will be 10 million, isn't it? Right. And this is also called the market capitalization. That gives you the market capitalization. Understood? Okay. Okay. Any questions? Next area is on authorized share capital against issued share capital, right? The authorized share capital is the maximum amount a company is allowed to raise from the market. That's called authorized share capital. And issued share capital means out of the amount that can be raised, how much have they issued? Authorized shares are the total amount of ordinary shares that may be issued. Total amount of ordinary shares that may be issued is called authorized shares. Authorized share capital. When company is formed, the legal documents state the authorized share capital. Right? It comes in. What is the legal document? Does anyone know? What is this legal document that they are referring to? Any idea? What is the document that gives the maximum amount of share capital? The authorized share, yes, very good. It's in the Articles of Association. It is in the Articles of Association. Sorry, Krishonika, you had asked a question. Explain the residual amount. Okay, sure. What I meant was, right, it's your equity is equal to all assets, total assets, minus all your liabilities. That is how you calculate equity. Right? All your assets, let's say you have just a very simple balance sheet. Assets of 100 and on the liabilities you have 80. Then quite obviously your equity will be 20, right? Why? Because if you want the residual amount is after settling all your liabilities. Using your assets, you have to first settle all your liabilities. Right? You have assets of 100, so using that 100, you can settle your liabilities of 80. Then you will be left with 20, which is the residual amount or the equity that you own. Is that clear? Yeah. Sometimes you might have negative equity. How? What if the assets you have is 80 and you have liabilities of 100? Assets of 80, liabilities of 100. Then your equity becomes 20 negative. This is negative equity. That means the company is going to go bankrupt. Okay, so if you have negative equity, the company will collapse because you can't service even the liabilities. Clear? Yeah, so authorized share capital is mentioned in the articles. Issued share capital is out of the authorized share capital, how many shares have been issued? Yeah. So market capitalization is calculated as the share price into the issued number of shares. Or maybe authorized share capital, which one is higher? Which one do you think is higher? Authorized share capital or issued share capital is higher? Authorized is higher. Right? Out of the authorized only you can issue the shares that you want. The authorized is always higher than issued. Now, how do you calculate market capitalization? The share price into which is authorized to issued number of shares. Yeah, it's not authorized, right? It has to be issued number of shares. See? Okay. Yeah, any questions? No questions? Then the nominal value of a share. Nominal value per share means the value of the capital given for a share, right? So you might say you are issuing 10 rupee shares. Each share is assigned a nominal value of 10 rupees. Issues of shares by a company may be at nominal value at a higher price or even a lower price. So if it's going at a higher price, that means at a premium. Lower price means at a discount. If they are issued at a higher price, the difference between this and the nominal value is known as the share premium. Okay, so these are very basic concepts. I'm giving you a few moments in between so that you can read and revise what you already know. Okay, so let's try this question. Question number 1, let us try it. It says company has the following details: authorized shares of 10,000, issued shares of 1,000, par value of a share is 10 rupees. Sam has purchased 100 shares. What is his ownership percentage? What do you think? What are your thoughts? So you think 10%? Authorized shares 10,000. Issued shares 1,000. Sam has 100 shares. What is the percentage ownership? Now, how do you calculate the percentage ownership? Is it based on issued shares or authorized shares? It's on, you're right, it's on issued shares, very good. So Sam has 100 shares out of 1,000, so his percentage ownership is 10%. He owns 10% of this company, of company A. Try this. Question number 2. X Limited has 250,000 authorized shares. It is issuing 100,000 shares at a nominal value of 10 rupees each. Value 10 rupees each at a share price of 15. You are required to state the share capital and share premium. Very simple. The share capital will be 10 rupees into 100,000, which is 1 million. And share premium is 5 rupees. Into 100,000, 500,000. Okay. Any questions? No. But nowadays in accounts, you don't show the share premium separate. Right? It's shown as part of equity. Current practice, no nominal value is considered, and you do not account for the share premium. So share capital is simply the issue price into the number of shares. So in this case, it is simply 15 into 100,000, which is 1,500,000. Share capital versus equity. Equity means the owner's interest in the organization. Equity capital is, share capital is part of equity. So this is a very important equation. Equity is equal to total assets minus total liabilities. Share capital is part of equity. Okay, understood? Yeah. So the types of shares, right? You have ordinary shares and preference shares mainly. Now, the main difference between ordinary shares and preference shares, this is something that you already know, is ordinary shares have voting rights, preference shares do not have voting rights. But when it comes to the payment of dividends or liquidation, preference shares will get preference over ordinary shares, right? And you cannot pay ordinary shareholder dividends without paying preference shareholders dividend. You also cannot liquidate ordinary a company and pay ordinary shareholders before you pay, until you pay preference shareholders, right? So they get preference. That's why they are called preference shareholders. But only thing, they don't have voting rights. There are various types of preference shares. We will get to that. By the way, preference shareholders will be paid in the case of a liquidation. Preference shareholders will still be below, in terms of priority, they will be below creditors. Although their preference, they only prefer, they get the preference on top of the ordinary shareholders, but not before creditors. Types of shares. Ordinary shares can either be voting or non-voting shares, right? You have voting. If you had noticed in the market, there are .x and .n. .n means voting, .x means non-voting. Right? So voting shares obviously have voting rights, non-voting shares do not have voting rights. Preference shares on the basis of cumulative dividends can be cumulative preference shares or non-cumulative preference shares. Then on the basis of redemption, they can either be redeemable or irredeemable. Okay. So if I put it up in a diagram, shares Sorry, can't see. Shares can either be ordinary or preference. Ordinary shares can be classified as voting or non-voting. Then preference shares can either be classified based on dividends or on redemption. Can be cumulative or non-cumulative. Based on redemption, they can either be redeemable or irredeemable. Ordinary voting shares. They are the virtual owners of the company. As if you buy ordinary shares, voting shares, you are the owners of the company. You can dictate terms. You can vote at AGMs or EGMs. You can exercise your voting rights. They have voting rights and control the workings of the company. And you can appoint directors and so many things using your voting rights. There is no fixed rate of dividends. Dividends is paid after dividends, and a fixed rate is paid on preference shares. At the time of liquidation, capital is paid back after preference shares have been paid back in full. Right? These are non-redeemable unless there is a wind up or the company buys back the share. Then ordinary non-voting shares have all the features of ordinary shares except voting rights. So that is the only difference between voting and non-voting. Quite obviously, they are similar apart from the voting rights. Non-voting cannot vote, as the name implies. Preference shares Preference shares are those shares which carry with them preferential rights for their holders. They usually have a fixed rate of dividends and priority as to the payment of dividends. Right? Because preference shareholders will be paid dividends prior to paying ordinary shareholders. Preference as to prepayment of capital during liquidation of the company. So if the company is being liquidated, they will get preference on repayment. Generally, preference shareholders do not have voting rights. So they won't have voting rights. Types of preference shares on the basis of cumulative dividends and on the basis of redemption. Right. What we have discussed in the board. On the basis of cumulative dividends, can be either cumulative preference shares or non-cumulative preference shares. Cumulative preference shares is where if you miss paying, you cannot pay a dividend on a particular year, then the dividend that should have been paid on that year gets accumulated to the next year. Right? So the second year, you have to pay both dividends. They are those shares on which the dividend at a fixed rate goes on accumulating until it is paid. Right, sir? You keep accumulating the dividend. Whereas non-cumulative preference shares, quite obviously, does not accumulate dividends. If you miss paying a dividend in a particular year, you don't have to pay it the next year. You don't. There is no such requirement that you accumulate dividends. Then, on the basis of redemption, they can either be redeemable or irredeemable preference shares. Right, redeemable preference shares will have a specific or given maturity date. They can be redeemed on that particular day. Whereas irredeemable will not have a redemption date. Redeemable preference shares, these are to be purchased back by the company after a certain period, as per the terms of the issue. Whereas irredeemable, you need not buy it back. Then how do you issue shares into the market? First one is offer for sale. Offer for sale is where the company which is issuing the shares will offer the shares to an issuing house. Generally, a merchant bank will act as an issuing house. The shares bought over by the issuing house will be reissued to the general public. Right? Offer for sale meaning you offer it to someone else to sell it on your behalf. Right? It will usually be a merchant bank. That is the role of a merchant bank. They take shares from the company that is offering, and then the merchant bank will start selling it to their clientele. That's called offer for sale. So you give it to one particular party, and then that party will look after the sale of shares to the public. Initial public offer. Now this is where shares are issued to the public for the first time. Right. This is where the company will directly issue the shares to the general public by preparing a document called a prospectus, which will be used to invite general public to participate in the share issue. Yes, the company will directly issue shares to the general public. Remember, it is the company that is directly issuing shares. They don't go through anyone else. By preparing a document called a prospectus. So a prospectus is a must. It gives details of the share issue as well as the company, things like that. What they plan to do with the money and all that, which will be used to invite the general public to participate in the share issue. Private placing. This is where the company which is carrying out the share issue will select large institutional investors and offer the share by conducting roadshows. Right? So private placement. This is where you don't issue it to the general public. Everyone can't invest, but a selected few investors, maybe large corporates or big funds or high net worth individuals might invest in using private placements, through private placements. The company which is carrying out the share issue will select large institutional investors and offer the shares by conducting roadshows. Roadshow is where the company will conduct a presentation to educate the selected investors about the share issue. Right? So it's called a roadshow. Then offer for sale by tender. This is where the company which is issuing shares will call upon the investors to bid the price at which they are willing to buy the shares. Yeah. So they will, it's like a tender, a typical tender. A tender process will be followed. They will ask investors who are willing to invest in this company to bid, and they will select the best bids out of those so that their requirement is filled. So different parties will get hit at different prices. Okay, that's because of the tender. Therefore, each individual investor will indicate the quantity of shares they expect to buy and the price they are willing to pay. The company should decide upon the price at which all shares can be issued and collect the highest possible revenue. Yeah. Okay, so this is like a typical tender. You try to maximize the inflows. All right, any questions up to now? No, so let's move on. Then stock exchange introduction. Now, this is where shares which have already been issued gets introduced to the stock exchange. This is where a company which has already issued shares, which already has shares in issue, wants to obtain a listing or a quotation in a recognized stock exchange. Okay. Clear? So it already has shares in issue and they want to obtain a quotation in a recognized stock exchange. So they might have issued share certificates to their investors, and instead of that, they want to now introduce the share to the stock exchange. In a stock exchange introduction, the company will not issue shares, new share. It will not issue new shares, but will obtain a facility to have existing shares traded in the stock exchange. So that will add liquidity to the share. Okay, so it's like a listing a company which had been private. So the company will not issue new shares, but will obtain a facility to have existing shares traded on the stock exchange. So already existing shares only will trade on the stock exchange. Those shares will be introduced to the stock exchange. Yeah, any questions up to now? No questions? Okay, so let's move. Categories of security markets, right? Categories. Now there are two types of, two ways in which you can give an order to buy shares. Can be either order driven or code driven. Right? Order driven markets and code driven markets. Now this is something that you need to understand. Might get tested at the exam. Okay, order driven markets as well as code driven markets. Order-driven market is where you tell your broker, let's say, for example, that there is a company, we'll call it A. Listed on the stock exchange. So A is listed on the stock exchange and you desire to buy A, right? So let's say the current price is 200 rupees. You want to buy, let's say, 1 million shares of A, and let's say at a maximum price of 180. You're not willing to spend 200, but maximum you're willing to pay is 180. So what you will do is you will tell your broker to buy. You will give him an order, right? You give the broker an order, and you will tell him buy 1 million shares of A at a price of 180. Okay. So that is the order you have given, to buy 1 million shares of A at a price of 180. Now, the price is currently 200. Okay, which means you want to buy it at a lower price, which is in your favor. When should you buy? When can you buy it? Can you buy it today? You can't. It's above 200. Sorry, it's above 180, so you can't buy it today. When do you think you can buy this? Can you buy this tomorrow? Can you buy? Will A come to 180 tomorrow? Will the price of A drop to 180 tomorrow? Will it or will it not? It might not. There is no certainty. There is no assurance that the price of A will drop to 180 tomorrow. So will it come to 180 next week? Again, there is no certainty. You don't know. It might drop to 180, it might not. How about next month? Again, it's the same. You never know. Might come to 180, might not come to 180. So next year, still the same. Right? Meaning, you are not certain whether it will get executed or not. There is no assurance that it will get executed. But by any chance, if it gets executed, it will get executed only at a price of 180. If it gets executed, it will only be done at 180. Nothing more, nothing less. Meaning, which implies, this is an order-driven market. Order-driven markets will have, let's put it up in a table. Order-driven and code-driven. Execution and price. Right. Order-driven markets, like what we just discussed, execution is uncertain. You don't know, you do not know for sure whether it will get executed or not. But if it gets executed, you know the price. Price is certain. Price is certain. Then if it's code driven, that means you call the broker, you ask him what is the current price of A. He says 200 rupees. Then you will tell him, it's okay, you buy 1 million shares for me. Yeah. So this guy will start buying at 200 rupees a share. Okay, he has to buy 1 million shares. Now normally what happens is, if there is buying that comes in the market and the quantity is pretty large, you might not be able to buy it at the same price. The price might change. Okay, first lot, maybe 100,000 you might buy at 200, then the second 100,000 might be at 200 rupees 50 cents. The third 100,000 might be at 201. Likewise, the price keeps adjusting. There is no guarantee that it will get executed only at 200. Okay, so what you might do is you can tell your broker to buy 1 million shares of A at a maximum price of 205. Okay, you are not going to exceed that price, but keep it below that. But one thing is sure, you will definitely get the shares. Shares you will get, but the price you do not know. Meaning, execution on the code driven that's called code driven market. It goes by the codes, it looks at the codes in the market and buys and sells based on the codes. Right? So if it's code driven, then execution is certain, whereas price will be uncertain. Clear? Any questions on that? Okay, sir. If no questions, order-driven markets, order matching and trade pricing rules are used to match the orders of buyers and sellers. Right. So this is how it happens. It's based on algorithms, trading algorithms. Exchanges and automated trading systems are examples of order-driven markets. Code-driven markets is where investors trade with dealers that maintain inventories of securities, currencies, or contracts. Right. So remember, if it's order-driven, then there is execution uncertain but price certain. Then if it is a code-driven market, execution is certain, price is uncertain. Now let me ask you a question. Right. Let's say you are an investor and you are in a hurry to buy. You feel the market will start moving. Which will you prefer? You prefer to trade in an order-driven market or a code-driven market? You are in a hurry to buy. What will you prefer? To trade in an order-driven market or code-driven market? If you're in a real rush, which market will you prefer? What do you think? If you look at the features of these two markets, yeah, if you're in a hurry, you obviously have to go for code-driven market, isn't it? Because order-driven, you might not get it. Okay. Whereas if you are concerned about the price, which market will you prefer? Order-driven or code-driven? Yeah, I will repeat the question. You're concerned about the price and you are not in a hurry. Which market will you prefer? Order-driven or code-driven? Yeah, order-driven. Good. Right, so I hope that was understood. You might get tested on those concepts at the exam. So make sure you understand and appreciate the differences between these types of markets. Clear? So the share market, now this is nothing new, it's already something you know already, and some of you in fact may have been trading in the share market also. The share market is a market of shares. It is a market like any other market, such as a grocery store. The share market is an established market where people can freely buy and sell shares issued by companies, right? So if you have you can go to the share market and buy shares. Obviously, you can't buy from a supermarket. You have to go to the stock exchange to buy. Why is that? Because shares are exchange traded. Like they're not like buying bread. Bread you can go to a bakery and buy, but shares you can't buy like that because shares are exchange traded instruments. Exchange traded. That's also two types. Over the counter and exchange traded. It's called OTC. Exchange traded. Because the shares will have to be bought through an exchange, and the exchange will guarantee settlement. Whereas over the counter, there is no guarantee. about the settlement. Yeah. A share exchange is an exchange or an organized marketplace on which shares are bought and sold. Share exchanges operate under strict regulations, right? So there are strict guidelines, rules, and regulations. You can't. You have to adhere to them. Very strict, regulated by the CSE, the Colombo Stock Exchange, as well as the SEC, the Securities and Exchange Commission. It's highly regulated, which when it's regulated, it enhances confidence of investors. So people are more willing to trade. Share indices, share market indices, which are very commonly used to measure and track performance of various segments of the market. Right? It's an index. It gives you, it's something like the BMI, the body mass index. If the BMI is too high, if it's above 30, that means you are obese. And if it's below 20, that means you are malnourished. Right? So it's around 20 to 25 where you should maintain. So this index, the body mass index, gives you an indication about your health. You know where you're heading, either you're gaining weight or you're losing weight. So that's the body mass index, an index. So likewise, in the share market also, you have indices. Right? Sri Lanka has two, the all share price index as well as S&P SL20. So you should know about these. The most liquid stocks are listed under the S&P SL20, whereas all the entire market, every share in the market is listed under ASPI, the all share price index. Share market indices, which are very commonly used to measure and track performance of various segments in the market, like the all share price index. They can track whether the market is moving up or down, right? So based on where the index is today, you can figure out whether the market is generally going up or going down. Equity investors generally refer to the buying and holding of shares of stock on a stock market by individuals and firms in anticipation of income from dividends and capital gains as the value of the stock rises. Because there are two ways of making money on shares. It can either be through dividends or through capital gains. Dividends and capital gains. Okay, so usually the stock, when you buy stocks, it has to be a long-term investment, because remember, capital markets, right? Capital markets means long-term funds. Yeah, so when you buy shares, you should take a long-term view on whether the share price is going up, that the share price will go up. So to back that, you need to have fundamental as well as maybe technical analysis. Right now, for example, you can look at the economy, you can figure out what is going on in the economy, and based on your observations, you can pick and choose on which stocks to invest in. Right? So generally, shares are long-term instruments, but unfortunately, most people think they're short-term and they try to trade short-term. Might end up losing a lot of money, right? So the idea is to trade long-term without going for short-term gains. That is how the share market should be used. All right. So do we have any questions? If you have any questions, please do ask. No questions? Well, if there are no questions, we can wind up. Okay. All right. So in that case, I will see you all next week. Have a safe week and go through what we have done. Thank you very much.